Okay, so we're in chapter 7, and we're on slide 15, and we'll go through the slide 27, and we'll finish chapter 7 today. All right, so on life insurance company balance sheets, they have a liability called an asset valuation reserve. An asset valuation reserve, okay? And this is money that's set aside to absorb fluctuations in market value of investments. So investments, as you know, investments are a huge asset for all insurance companies, but life insurance in particular. And that you know that life insurance companies have a little bit more stocks than bonds, but when you look at the general account, it's still dominated by bonds. And so these are asset valuations that are not caused by changing interest rates. So what does that mean? Well, life insurance companies invest primarily in bonds, and so they have a portfolio, an existing portfolio of bonds, and when interest rates go up, the value of the bonds will go down, okay? That is the current market value. If the life insurance company was going to sell the bond at that moment in time, they would get less than the $1,000 par value that they paid, okay? So bonds are a little bit different from stocks. When you buy a stock, let's say you buy a stock for $1,000, par value, same par value as a bond, okay? But the market price is $1,000. If the stock price goes down, you have no guarantee that that stock price is going to go back up. You have no idea what you're going to get for that stock at any point in time. But with a bond, there is a promise that is made that for each bond, at a certain point in time that we call maturity, you will get $1,000 for each bond. So if interest rates go up and you're holding a bond, it's a 5-year bond, and your plan when you bought that bond was to hold that bond for 5 years. Interest rates go up, and at that moment in time, the value of your bond goes to $900. And I had to deal with clients to explain this to clients. I say, oh, my total portfolio was only up 8%. It's like, well, yes and no. Your stock portfolio was up 12%, okay? But your bond portfolio was down 4%. So your total portfolio was down 8%, but guess what? The good news is we're not planning to sell any of your bonds. So every bond that you own, you will get $1,000. You will earn a certain rate of return on your bond. So that is a temporary situation with a bond. So you don't want that flowing through. If your asset value goes down and your liabilities, so what are your asset values? Your investments, your bonds. So if your bonds go down, but your liabilities stay the same, what happens to your owner's equity, or what we call surplus in the insurance industry? What happens to your surplus? It goes down, okay? But it shouldn't, because you're going to hold those bonds. And so we set aside money for legal and statutory reasons as a cushion, so that you, as an insurance company, won't drop below the capital requirements that you are supposed to maintain. Just like a bank, insurance companies have to maintain a certain amount of surplus. Otherwise, the regulators are going to shut them down. Okay? So this is a buffer for insurance companies to make sure that they won't have a problem. Now, 2 components to asset valuation. One is for bonds. Okay? Bond defaults and permanent changes in equity value. And basically what it means for both is Bankruptcy. Bankruptcy. This, when a bond goes from 100, which is 100% of par, $1,000, to $30 because of bankruptcy, okay, that's different from a bond going from 1,000 to 900 because of a change in interest rates. When a bond goes bankrupt, you're not getting paid. You're not going to get paid. You might get paid 30 cents on the dollar. And the same thing goes with stocks, okay, and with real estate. So there is a regulatory definition that accountants have to use with real estate and stocks and intangible assets like copyrights and patents, where a judgment has to be made whether the value of the asset has been permanently impaired or is it temporary. And based on the criteria for making that judgment, if an asset's value is judged to be permanently impaired, then you have to write it off, okay? And if you have to write it off, you have to have money set aside to cover it. And that's what these reserves are for. The whole intent is to make the insurance companies as financially strong as possible. Not for the stockholders, but for the policyholders. Okay? This is all about making sure that when a policyholder makes a legitimate claim, the insurance company will have the money to pay the claim. That's what this is all about. All right. So they comment that surplus is less volatile in the life insurance industry than it is in the property and casualty industry. Because in the property and casualty industry, you have catastrophic losses all the time. Okay? Every time a hurricane hits, every time a tornado hits, every time an ice storm hits, okay? Every roof in Searcy has either been replaced in the last year or is in the process of being replaced. If you drive around, you can see them everywhere. Why is that? Hail. We had a hailstorm or 2 or 3 that came through, and they're all being repaired. But how many clash losses, catastrophic losses, have we had with human life that were completely unexpected? Not many. The last one I can think of was 9/11, okay, where we lost 3,000 people. And even when the hurricanes come in, the loss of life is not very high. The loss of property is incredibly high, okay? Now you might say COVID, you know, that's another way for people to die. But the truth is, with COVID, if you look at the people who have died, the question then becomes, did they die just because of COVID, or would they have died in a short period of time anyway because of some other variable? And that is a really difficult thing to know. But if you say, oh no, I don't want to look at that, it's got to be about COVID, you're being dumb. Okay? You're burying your head in the sand. There are all kinds of things that kill people. Okay? And what we really want to know is the science, the facts. So COVID, 200,000 people have died, and it's been associated with COVID. And I'm not in any way downplaying that. The question is there something else that would have killed those people in pretty short order? Or were they otherwise healthy people that would have lived for another 10 or 15 years, except that they got COVID? And that's a really difficult issue. And you can say that about any other issue, health-related issue. It's difficult to pin it down and say, what one factor can we point to that killed people? My mother died from pneumonia, okay? But she had Alzheimer's. And a lot of Alzheimer's patients die from pneumonia. And on her death certificate, it says pneumonia. But she was very vulnerable because she had very severe Alzheimer's. So I don't know if any Alzheimer's patients who die actually have Alzheimer's listed as the reason for death. Because Alzheimer's doesn't technically kill anybody. Some die from starvation because they can't swallow anymore. You know, so it's, how do you answer those questions? It's very challenging. And I'm not saying that politically. It's just challenging. All right. So here are the major expenses or cash outflows that life insurance companies have. Obviously, death benefits paid to beneficiaries and annuity benefits paid to annuitants. Who are annuitants? They're people who invest in the annuity. I talked to one this morning. I said, you got to send me your annuity so I can read your contract, which is going to be about that thick. And he goes, I don't know the first thing about it. I bought it. It sounded like a good idea. The guy talked me into it, but I get a certain amount of money, but that's all I know every month. Then I said, I need to study it so I can see if that is a beneficial part of your portfolio. And if it is, we're going to keep it. And if it's not, we'll liquidate it and we'll put it somewhere else. All right, surrender refunds is when people say, I'm not paying any more premium, and I want my cash value back. Okay? And then taxes, which are premium taxes in addition to income taxes, and then dividends. These are the expenses that are directly related to the policies. Now you have all kinds of SG&A expenses related to operating the company. Okay? But these are the expenses that are directly related to having a policy. All right, so net gain on operations doesn't look any different than any other business. You've got your revenue, which is your premium, less your expenses, less your dividends, less your taxes. Okay? And again, your expenses there are two categories of them. One are policy expenses, and the other SG&A expenses. All right, how do we gauge how well a life insurance company is doing? Well, the same way we gauge how any other company is doing. We look at return on assets and return on equity. Return on assets and return on equity. And remember, I go over this in ManFin, when you take econ, they tell you that maximizing your cash flow is your goal. And I say, no, that's an incomplete thought. It's maximizing your cash flow in relation to the amount of investment that you put in. It's maximizing your returns. That's what you're trying to do. Okay? Because maximizing your cash flow means you'll continue to throw money, invest money in a company in order to gain additional cash flow. But the question is, what happens to your return? Okay? So you need to be mindful of both the cash flow side of it and the asset, the amount invested in the asset side of it. All right. So this is some redundancy. We did talk about this in an earlier chapter about rate making. There's some additional information, and honestly, I need to consolidate the two sections and have one section on rate making. Okay? And I'll do that. So state laws, again, insurance is state regulated, like banking. The only time the feds step into regulating financial services is when state laws do not address a specific problem. Then the federal laws will step in. All right. So states require that rates have to be adequate. You can't have a loss leader. You can't set a premium below what you think you need to cover your expenses and make a profit. Okay? You can't have a low premium in order to gain market share and run people out of business. That is anti-competitive behavior. And that's a very important function of government, because people in capitalism will play games It's like, we've got deep pockets, we're going to cut premiums, and we're going to gain 95% market share, and we're going to put these other companies out of business. And once they're out of business, we're going to jack our premiums up. And it's happened over and over and over throughout the history of our country. And it's a tough issue. How do we maintain competition? Yeah.
Isn't that basically what OPEC does with oil?
Yes, that is exactly what they do. They increase production in order to cut the price of a barrel of oil below the cost. They know what the cost is to extract oil using fracking. So if they can drop the price of oil below that cost, they know that they will run these companies that do fracking out of business. All right. Let's see. So, for competitive reasons and for solvency reasons, okay, once again, the main concern of the regulators is this. The insurance companies have to be strong so they can pay claims. Okay? At the same time, rates should not be excessive. So what are you seeing? You're seeing a challenge. You're seeing a balance. The regulators have to say, you can't be too cheap and you can't be too expensive. Okay? You can't gouge the public. They need your product. We're regulators. That's one of our charges, is to make sure that you're not gouging the public. So policy holders should not pay more than the actual value of their protection.
So would this be an example of both a price ceiling and a price floor?
Oh yeah, absolutely. Absolutely. You know, one thing that makes people mad is we've had an ice storm and a generator that used to cost $600 now costs $2,800 for just a short period of time. That period of time when you have to go out to Lowe's and buy one. And so when that's called gouging. And the question is, does it cost? Now sometimes they can say, listen, we can't get trucks into the area. The roads are covered. They're flooded. They've got tree branches, and we can't bring in product. So we have to figure out a way to stem the outflow of our inventory. If they can justify charging $2,800, that's one thing, but most of them can't. It's gouging, and you have to look out for that. It happens all the time with gasoline. When you have gas shortages, these gas stations will jack up the price. All right, you can't discriminate unfairly. Okay? And that means that when you're setting a premium for exposures that are similar with respect to the losses that you expect and the expenses, you can't charge significantly different rates. You can't pick and choose. I like you, I don't like you. If the exposures are similar, the rates have to be similar. Once again, if you're going to charge a different rate, you better have a business reason to justify it. Okay? That's the job of the regulators. We're not going to let you discriminate. All right. So, with regard to the rate-making objectives that the firms have, not the regulators, but the firms, clients need to understand your rates so that they can shop. They need to be easy to understand. And the agents need to be able to understand the rates. Okay? So your agents and your customers need to understand what it is they're dealing with. Okay? And rates need to be relatively stable over short periods of time so that people can shop them and people can count on them. Okay? And you got to be careful of the bait and switch. Make an offer, 2 weeks later somebody accepts, and then they say, no, that's no longer available. You should have done it 2 weeks ago. Okay? That confuses the public. Okay? Now rates do need to be responsive to changes in underlying conditions and economic conditions. So once again, if a company changes a rate, it's okay for them to do that if they can point out that there are legitimate reasons for changing the rates. Okay, it's not saying you've got to stick with the rate. All right. Rating should encourage this. We talked about this in chapter 1 about encouraging loss control activities, moral or attitudinal hazards. You don't want someone to think, oh, I've got insurance, therefore I don't care if I have a loss or not. I'm going to walk into the store and leave my keys in the car, because if my car gets stolen, I have insurance. So rates need to encourage people to continue to try to take care of their stuff. Okay? And if they don't, then losses go up. And if losses go up, rates go up for everybody. And that's the main argument that insurance companies make about fraud. Before you make a fraudulent claim, understand it is not free money. It might be free to you, but you and everybody else who pays premiums will have to pay a higher premium because of fraud. All right. So the rate is the price per unit. It's a standard measure that helps people comparison shop. Okay, so buying insurance is kind of like buying a car. It is often difficult to find two vehicles that are exactly the same. And it's very difficult to find two insurance policies that are exactly the same. And if you're going to comparison shop, you have to have a way to compare the policies so that you can make a good judgment. All right. So an exposure unit is the unit of measure used in insurance pricing. So let's look at that. Let's look at a definition of what that unit of measure is. So an example is, how much are you paying for each $100 of coverage of fire insurance? Okay? And that enables you to compare a $500,000 policy with a $400,000 policy. How many, if you divide 500,000 by 100, you get the number of units. And you can compare the pricing per unit. It's the same thing we do with PE ratios in investments. It's the same thing we do when we go to the grocery store and we look at a large box of Cheerios and a small box of Cheerios. One thing we look at is, what is the price per ounce? Now, we may not pay $6 for a large box of Cheerios, even if the price per ounce is 18 cents, and the price per ounce for a $2 box of Cheerios is 26 cents. We still might choose to get the smaller box. But at least we have a standard way to compare. Okay? So for product liability, which is somebody